Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 27th of June. It is the second last trading day of the quarter, of the half year, of the month, and Brent crude oil is trading a little bit above $85 and change. Not much movement this morning in early Asian trade. Market is sort of back, one would say, in its ultimate happy place, nearly spot on the average oil price for the first half of the year, which for Brent was about $84 a barrel. And so we're just a little bit above the average. Ole Hansen, head of commodity strategy at Saxo Bank, taking a half year report card, teacher Ole Hansen, what grade are you going to give OPEC Plus for their performance in the first half of this year?
I'll give them most certainly give them a pass. We've seen, as you mentioned, very steady oil prices. We've actually now for the last 9 months seen lower highs and higher lows, meaning that we are converting steadily towards that average price that you mentioned, both in WTI and Brent. So OPEC Plus having, I'd say, a great deal of success in keeping prices stable. The question is obviously whether it's stable at the level that they would like to see. That is probably more questionable. I'm sure they would have liked to see it $5 to $10 higher, but the economic developments across the world has really not allowed that to happen, especially when we look at the slowdown in China, which just continue at this point. Data continue to disappoint, and that's also to a certain extent weighing on the prices. But generally, they most certainly passed. They managed to keep prices steady and stable and at a higher level than we otherwise would have seen.
Andy Lavin, senior partner at Econs. Andy, your thoughts, similar question, grade first half of the year for OPEC Plus. What's stopping this oil price? It seems to hit its head on a ceiling at $85, bar the exceptional moment like will Israel and Iran go to war? We saw 90 plus, but besides that, we've got some kind of a ceiling on this market. Your thoughts on the first half review?
I would tend to agree with Ole in terms of OPEC's kind of behavior and ability to kind of keep the ship steady. And I think that has been the message of the first year. It's things have been very challenging, both to the upside and to the downside. There's a lot of uncertainty. And in a world like that, arguably, OPEC would say we're doing exactly what we are meant to be doing, which is providing the energy to the world in a nice, steady state. And we're keeping everything calm. And the reality is, as you pointed out, that the big moves typically are geopolitical and things that surprise people. There's pressures upwards, there's pressures downwards, but the reality is the market's trading sideways, and the calm, steady waters of OPEC have supported that.
Mike McGlone, senior macro strategist at Bloomberg Intelligence. Mike, despite that somewhat positive review from Ole and Andy, this market has always seemed to want to sort of trend downward in the first half of the year. We saw it as recently as after the OPEC Plus meeting in early June, that sort of big sell-off. There's still a weakness in this market. Your thoughts on the first half?
So I guess my bias is still towards lower prices. Yes, we're locked in a range, but a lot of this has been markets shifted from a market of commodities to a market of commodity markets. And managed money, speculative futures are being a big driver. They get way too long. They're the high this year. Brent around 92 and sold out massively down there, low around 78. But the transition I see is towards lower prices. Certainly that happened in natural gas. You look at managed money net positions in US and European natural gas are the longest in 2 years. That's probably a problem to head lower. Supplies are continuing to increase. And to me, it's a matter of time that crude oil does what it normally does. It gets to its cost of production. The US sits around 55. It gets down below that and kind of alleviates its excessive supply and demand out of the US and Canada, diminishing demand, and certainly pretty serious economic issues coming out of China. You look at Chinese government bond yields at 222, the 10-year note yield, that's 200 basis points less than the US. They're plunging. I see US unleaded gas demand, US is declining. Diesel demand is declining. Container board demand is declining. And you have Fed funds rate about 300 basis points above PPI. The average for the last 20 years is 150 basis points below PPI. So to me, it's just a matter of time that crude oil and most commodities go lower, and gold continues to move higher.
Well, just picking up on that, the first half of the year, of course, OPEC had to really work very hard to keep 5-6 million barrels of oil supply off the market to keep this price in the sweet spot of the low 80s. That's a lot of heavy lifting that's going to go away or start to wind down in the second half of the year. But I wanted to get your thoughts. How much of this market and looking across the commodity complex is kept up by healthy demand, by healthy global economic growth outlook, and not by this massive effort to keep all this supply locked in?
Well, I think at this stage, it's most certainly a combination because the global economy is not exactly firing on all cylinders. We are still, as Mike mentioned, having very high Fed funds rates. The prospect of seeing them significantly lower is quite slim at this point. Remember, we started the year looking for 6 to 7 cuts. Now the Fed is telling us it's 1. The market believes it's 2, but nevertheless it's a small reduction. So that is potentially weighing on demand. We're seeing a stronger dollar as well. The dollar hit the highest level on a broad basis since November, and that's also weighing. But then on the supply side, we are excuse me. I agree with the precious metals. They are supportive through all this, but even the metal space, where there is a tug of war right now between the long-term potential positive outlook in terms of green transition demand and the short-term outlook, which is weighing on prices, especially with the inventories building up in China. So I think apart from the oil market, where it's most certainly a question of supply being held back, it's a bit of a mixed bag across the rest of the sectors. And if you look at the food commodities, it's as usual quite volatile. It's weather driven. We've seen some very big spikes in cocoa and coffee. We're seeing wheat prices doing a full circle back to the recent lows, and it's all weather news that's coming in on a week by week basis. So that's really what's driving it there.
Andy, I wanted to get your thoughts. I mean, a month out now, nearly a month since the OPEC Plus meeting, I'm still trying to digest what the biggest takeaway is from that. And through the prism of the big sell-off after the OPEC Plus meeting, we dropped, from the days before to the days after, nearly $10 a barrel. We've since recovered all of that. But looking back at the last month rather than the last 6 months, what's your assessment of that sell-off and the recovery? Is that baking in that the price is baked in that the OPEC Plus will raise production in the second half, or has the price baked in the Saudi comments? Oh, don't worry, we can always not do it if the market doesn't like it. What's your assessment of the big takeaway from that meeting now a few weeks away?
So my sense is that the last month will have taught them a very salutary lesson that you need to be very, very wary of what you project. I think the demand in the short term for oil specifically is not strong. There is nothing out there that really says you can put anything back on the market without actually bringing the price down. So I think the fact that there was the sell-off and then it's come back, and I think that the volatility is reducing slightly, I think that will have taught them we need to go very slow when we bring things back on. And it really needs to be in response to a clear picture that the demand is going to be coming back. If the world doesn't believe demand is coming back and OPEC start opening the taps, oil price is only going one way, and that's down.
Picking up on that, Mike, a lot of that might to do, the direction of travel with the U.S. It seems to me that the second half of the year, and maybe every half of every year, is in the hand of the U.S. economy. But I'm trying to read what is the health of the U.S. economy and the oil industry. We've seen very little growth in supply after a massive increase last year. Why? $80 oil would seem like a profit point for companies. is the US economy in a good shape and rates are being cut because the outlook is good or the outlook is bad? Just give us a sense what you think the second half of this year looks like from the US, from the oil supply point of view and from a kind of economic health point of view.
So US and Canada, liquid fuel and crude, the excess of supply over demand is around 6 million barrels a day. In 2008, it was a deficit of about 10 million barrels a day. It's about OPEC spare capacity, which is rising. They're both rising. The trajectories are bad. When you look at overall U.S. economic situation, it's quite bad if you ignore the stock market. Stock market is doing fine, but retail sales minus CPI are negative. The demand for diesel consumption in this country has dropped about 7% from the peak in 2022. That's the same trajectory as 2009. Container board demand has declined. Diesel demand is the same as it was 10 years ago. It's never happened in this country that we've had 10 years of unchanged demand for diesel without a recession. So everything I see from a commodity, certainly from a petroleum demand standpoint, is negative, and it's heading towards a typical recession you'd expect after the significant rate hikes and the big pump in liquidity that's going away. So to me,
sorry, but to interrupt. I asked a question. I was at the FT summit in a commodity summit in Lausanne in early May, I think it was, and I asked the question: Are the recessions of the old style that we grew up with and lived with in our adult life now a thing of the past? And what we're seeing right now is the new recession. This is what a recession looks like when you print $10 trillion. You don't get the 2 quarters of negative growth and all of that sort of fun, basic dimensions, but you get people working 3 jobs who are making money but are really unhappy. I mean, what does recession in the new world look like in an American economy where you seem to have full employment?
So the pendulum swung way too far last year towards a severe recession. It swung way too far this year and now towards no recession. And it's just swinging back a little bit to what normally happens in a typical cycle. And it's what you said that makes sense. People think it's different this time. Well, I just point out I'm looking at diesel. The price of diesel, average price of diesel in this country for the last few years has basically bottomed around $2.50. Right now, it's $3.70. I see it going to those lower levels. I see WTI going to the cost of production. I see unleaded gas, the price is going to $2.86 versus $3.50 right now, just based on normal demand and supply. And then you look at very simple things like BYD. The whole world has to push back on these very cheap EVs coming over that get tremendous gas mileage. So in terms of the U.S. in recession, there's still inverted yield curve. Leading indicators are still negative. As I mentioned earlier, Fed funds are still 300 basis points above PPI. It's a matter of time. And the crack will come when the stock market drops a little bit. Yes, we have, I think it's being held up by what you mentioned, 6% fiscal deficit is unheard of outside of a war or recession, and that's helping keep things elevated. We still have a little bit of a leftover from all that money pump, but it's keeping Fed funds tight, and it's just a matter of time we tilt lower. I see it in virtually all my indications, and even mentioned earlier, Ole mentioned food. You look at the price, the typical cycle in commodities is they go up, and then they go down. They go down because they went up, and that's clearly happening in the most elastic grains. We're basically 2 months away from a normal, if we have normal weather in this country, from the price of corn going to the same price it was in 2019, from soybeans dropping to 10. Wheat's already been mentioned. That's just the normal cycle. The supply excess is overwhelming at the moment, basically because of the incentive of prices. And then you look at the overall economy, the indicators are all there. The Fed sees it, and there's some key things that I like to point out. I'll end with this. The unemployment rate in the U.S. is at 4%. Last year, it bottomed at 3.4%. It's never bottomed from that low without going towards 6%. It's on the current trajectory right now. It's a matter of time.
Ole, looking to the second half, of course, this is the year of multiple elections. We've had a number behind us in the first half, most notably India surprise result there with Narendra Modi not getting a majority and seeing this sort of resurgence of the Congress party, and now Rahul Gandhi holding the opposition leader position, and so things could slow up there. As you look forward into the second half, the one election that wasn't even on the cards now could be the big black swan event, and that is the French election coming up for the parliament in the next week. Your thoughts on how big an event that could be, your outlook for it, should it matter? Do we care of the commodity markets?
Well, it most certainly depends on what kind of discipline they're going to show on the fiscal front, because they are already talking about borrowing money that they can't afford to borrow. And if that's the case, then I think that's probably also what we're seeing in the US. They are all obviously promising things that costs and that needs to be funded. And as long as investors are prepared to buy those bonds, then that's I suppose that's okay. But the rising debt burden we're seeing across the world just points to one corner of the commodity space, which are the precious metals as a safe haven, and that will continue. But the elections will most certainly play a part because of the potential impact on the spending afterwards. What kind of promises been made? We're also seeing the UK election. Labour is looking for I'm sure to open the purse as well. So yeah, it will be interesting to see how market takes these news, and especially on what kind of debt that comes with some of the decisions they're going to make, and what impact that will have on the market.
Just to follow up, Ole, on that, what about the implications for the war in Ukraine? I mean, the far right in France has been, I don't know what the right framing would be, but let's say sympathetic, relatively warm to Putin and Russia. Does this change if they're come into power? Does the war in Ukraine picture change from a European perspective?
Well, I'm not an expert on that, but there's no doubt there is a fragmentation going on in Europe regarding the war, because it's dragging on, it's costing a lot of money. But I think at the same time, it's also supporting, creating a renewed sense of urgency in Europe. We have been falling asleep for decades. Cheap energy from Russia, US providing the security, and look, going forward, that these are obviously not left. We are not assured about that anymore. So we are seeing obviously spending towards self-reliance picking up, and that will help growth in Europe. But unfortunately, based on some sad developments.
Andy, looking to the second half of the year, we've mentioned it already. The big sort of supply side story is the fact that OPEC Plus, or the 8 countries within OPEC Plus that have committed to the voluntary additional cuts, are going to unravel them in the fourth quarter. Your thoughts on the inevitability of that? My sense is that regardless of market dynamics, we're just running out of time for this scale of cuts to remain in place, for these countries to continue to carry such a heavy burden for the global oil industry, for the global oil market, that this is inevitable regardless of market dimensions. Your thoughts on that?
Oh, I don't. It cannot be inevitable, because the reality is, for the OPEC countries, production is just a proxy for how much money do I get. And as was said very early on, they're probably not at the level of production they would like them to be, and they're not at the level of prices they'd like them to be. So unless there is some very, very bullish news in terms of the economies around the globe, and specifically to do with demand, it would be naive to say we're going to be able to put 5 million barrels back on the market at any time in the next 6 months.
Well, of course, that's not what's on the target here, right? We're talking the fourth quarter with the cuts that are agreed to, or the increase, let's call it, because that's what it is of the 2.2 million from those 8 countries, and that's spread out over 12 months. And so the fourth quarter, they're only going to bring back 500,000 barrels, one quarter of that 2 million. So the increase in the 4 quarters, 500,000.
That's to a certain extent, the number is kind of sugarcoating, because the reality is it's the message you're sending to the market. And the message that the market needs at this point in time is, we will provide stability. Unless there is a very clear sign of growth in demand, putting any more production on the market is going to move the market in one way, and that's down. I mean, I don't think any of us have actually been very bullish about the second half of this year in terms of any economies around the globe. So where on earth OPEC would get the kind of the
But
rationale that says, oh,
Andy, you live in the UAE as I do, and you know the weight that they are carrying now nearly 2 million barrels of idle capacity in a country that has close to 5 million barrel a day capacity, production capacity, and is only producing over 3 million of that. So this is a very significant burden for the country to carry, regardless of where the price is at. The cost of that is significant.
no, I totally agree. So the question is really not about OPEC, but it's about those constituent countries. So you could foresee the issue being that actually the global demand is not there. However, those countries that are shouldering the burden, as you put it, are finding it so tough that they actually cannot see how they can continue. And therefore, you can see some fractions opening up in OPEC that says, I don't care about the economies. I need more money. Therefore, I need to pump more oil. That's probably going to go on behind closed doors. And I think they'll find a way around it because ultimately, we've seen what happens before. When OPEC starts to try and kind of compete for market share, it's not a good place for them at all.
Let's go to the survey question, which is sort of looking to the second half of the year and where we want to focus our conversation. Brent crude oil has averaged $84 for the first half of 24. What will it average in H2? Higher, lower, or more or less similar? Your thoughts on that, considering as we have as the current plan, OPEC Plus will add 500,000 barrels a day in the fourth quarter. That's the current decision. So higher, lower, or similar looking ahead to the markets and to see where they go. Mike, looking at the outcome of where we're at in the sort of election cycle, the sort of biggest story of the second half of the year, the oil price. So we had a big op-ed in the FT today with Daniel Yergin, the sort of guru of all in American retail oil, and he is saying that the price at the pump is going to be a big deal to be digested on the political side this summer and into the fall. Your thoughts on where the old-fashioned price at the gasoline pump is going to hit the election cycle?
Yes, I appreciate you mentioning that. I mentioned earlier, I published it on it last week. I think the average price of U.S. unleaded gasoline for the last 10 years is $2.86. Right now, it's about $3.50. It's heading towards $2.86. I don't see what stops it. Just looking at supply and demand. And of course, we're heading towards the election. But it's also the key thing is my EV is 10 years old. The market's just going that way. The world's changing so fast. So, and then if we do get the President Trump 2.0, we all know that means drill at will. So even without President Trump a second term, it's heading that way. So it's almost a guarantee if he does get elected, they'll just put on more supply. So I also look at it from a macro. The elephant in the room, which Andy touched on a little bit, is we all know that interest rates in the rest of the world have started going lower. U.S. hasn't started yet, so we're just nowhere near that cycle yet. You have to get to a trial in interest rates before demand starts picking up. But the elephant in the room is the unlimited friendship between President Xi and President Putin. And that Cold War is just heating up every day. We see it. But it also means a major shift out and away from China. And certainly from this country, it's bashing China is just becoming quite relevant for an election cycle. So I don't see what helps this world's largest commodity demand pull to do anything but just do a normal reversion or rapidly emerging market, which is bad for all commodities, most notably crude oil and the base metals. In the U.S., it's just a matter of time we get to a normal cyclical recession. Remember, we do have a yield curve that's inverted. The 10-year note is 100 basis points less than Fed funds, and virtually every other major 10-year note in every major country in the world, most notably China, Japan, Germany, UK, are lower than the US 10-year. You see the tilt there? It's all going that way. And now we've already convinced ourselves we see crude oil heading lower, which, since we all agree, maybe it's somewhat of a bullish sign. But you just look at the trends, it's not favorable. It's I'll end with this. We will probably get deflation worthy of the significant inflation we got on the back of the biggest money pump in history.
Ole, your thoughts on the sort of big themes for the second half of the year? What will you be watching? We saw that despite sort of thoughts at the beginning of the year that sanctions may come back, that the Iran might get curtailed again, the efforts to put a tighter grip on Russian exports would come in. None that hasn't happened. Your thoughts on the big issues for the second half of the year and where you see sanctions playing any impact on the markets?
Well, sanctions might be tightened even more, but what we've seen now for the past couple of years is that oil and fuel always find their way to the market in different ways, and that is likely to continue, I would imagine. So I think really for an oil price perspective into the second half, the big question is who's going to be right in their assumption: OPEC with a 2.2 million barrel production or demand increase, or IEA with less than 1 million barrel. That will really set the stage. And obviously at this point in time, it looks like we are getting closer to the IEA figure than the OPEC figure. So something has to happen in the second half to justify that kind of lofty expectations. But what I will also be watching, and I think this Friday we have the monthly production report from the EIA. And we've basically seen US production now flatlined since September last year, and going somewhat against expectations for continued growth. And if that is repeated, that may to a certain extent take a bit of pressure off OPEC, simply on the sign that even at these levels that US production growth is continuing to stall.
Andy, your thoughts on, and I'd welcome your insights. Obviously, you spent a lot of your career with the international majors. Your thoughts on where the majors are going into the second half of the year, kind of moving away on the European side, away from the energy transition, but yet on the American side, not really boosting too much supply out of the shale patch. Where are the majors going in the second half?
So in the second half, I think the reality is that the majors certainly they've already made their plans for the second half. They're not changing their plans in terms of whether it's shutdowns, whether it's new wells. That's already baked in. I think the reality is that the focus is on demand. Where's the demand coming? That's the story for the second half. I do think, as was pointed out, the US production is really interesting, because if you go back, not that far, 3-4 years ago, it was almost production was growing as long as there was money to be made. That does not seem to be the case anymore. It's almost like they've grown up and kind of gone, well, we can't keep pumping money. And this is what Omar has been saying, right? He said shale is dead. It's not died yet. It's not been dead and buried, but you are starting to see signs that the kind of more mature people are saying, well, we can't keep pumping money into this, because actually in the long run, it's not going to make us any money. And I think that's probably
so on that point, Andy, we've seen just the majors, I mean, Exxon and Oxy, buy out the biggest players in the shale patch. Your sense of they bought them to sit on them, to sort of, bank the reserves as a bonus, but not actually the production?
So I think two things. Reserves is one piece. That's one of the measures they get seen about, and they're able to get nice cheap reserves. But I think the other element is it's cash flow. It's just about short-term cash flow. It's a way for them to boost their short-term cash flow so that they can actually make their markets, their share prices look good. They can return shares and cash to their investors. But fundamentally, it's not to develop in the long term, I don't believe.
Last word to you, Mike. The week in which we have the first US presidential election debate, is this likely to deliver some shock and awe, or awe and shock? I don't know. But nonetheless, it's a big moment. Is there still a window to withdraw one of or two of these candidates? But your thoughts on this event as being in any way revelatory or change the direction of things?
I enjoyed it last time because I didn't watch debates. I watched them on Saturday Night Live, the parodies. It was more fun because but this time it's the expectation. It's entertaining how the Trump campaign has pushed the expectations for Biden so low. All you have to do is be average. Now they're complaining. They're assuming that he's on drugs and performance enhancement drugs. So it's entertaining. All he has to do is be a normal, good person who knows what he's doing, and he wins. So its expectations are so. The key thing we're seeing globally is those incumbents are being voted out.
Yeah, incumbents being voted out. Hard to change the trajectory of that, it would appear, despite the stock market at records and employment looking pretty decent at 4%. We'll leave it there. Brent crude oil at $85.15. WTI essentially nearly $5 back from that. The ceiling, is this 85 a ceiling? It doesn't seem to get much higher unless there's some spectacular event like we saw in May with the face-off between Israel and Iran. That aside, hard to see this market having too much upward momentum, but we will see if the second half, everybody's flying this summer. We could see aviation fuel off the charts, but we will leave it there. Great to have the comments at the end of the quarter. Ole Hansen in Denmark, Andy Levin in Dubai, and Mike McGlone in America. Thank you so much for your insights today. Have a great end of quarter and look forward to catching up with you all again soon. Bye-bye.
Thank you. Bye-bye.